Have you spent your whole life working, saving, paying into the system, believing retirement would finally bring peace of mind? Now here is the uncomfortable question. What if the biggest pressure on your retirement income is not inflation, not energy bills, not even market crashes, but the tax system itself? In 2026, millions of UK retirees are quietly being pulled into paying more tax. Not because they are rich. Not because they made risky investments. But because of frozen thresholds, rising pensions, and automatic tax rules most people never notice. Today we break it down clearly and simply. On paper, things look positive. The state pension goes up. Wages have gone up. Interest rates have risen compared to a few years ago. So why do so many retirees say their money feels stretched? Because when income rises but tax limits stay frozen, more of that income becomes taxable. This is not always announced as a tax rise. It happens quietly. And that brings us to something called the personal allowance. Right now, the personal allowance, which is the amount you can earn before paying income tax, is £12,570. It has been frozen for years. Now here is the key point. If your state pension increases, but the tax-free allowance does not increase, you move closer to paying tax. This process is known as fiscal drag. What does that mean in plain English? It means inflation pulls you into paying more tax, even though tax rates have not changed. Let me ask you this. If your pension rises by a few £100s, but your tax-free limit stays exactly the same, who benefits? The Treasury. And many pensioners only realize this when they see tax being deducted. Now let's talk about something that catches thousands of retirees every year. Taking a one-off withdrawal from a private pension. Imagine this situation. You need £3,000 for home repairs, or to help family, or to top up savings. So you withdraw it. But HMRC may apply what is called an emergency tax code. The system assumes you will take that same amount every month for a full year. So if you take £3,000 once, it might treat it like £36,000 annual income. The result? A large chunk is deducted immediately. Yes, you can reclaim overpaid tax. But it can take weeks or months. In the meantime, your own money is sitting with HMRC. So here is the question. Before taking money from your pension, have you checked how it will be taxed? Let's compare two retirees. Both have £50,000 in savings. Both earn interest. One keeps it in a normal savings account. The other keeps it inside an ISA. An ISA, which stands for Individual Savings Account, allows you to earn interest without paying tax on it. Outside an ISA, interest can become taxable if it goes above your savings allowance. Now, when more retirees are being pulled closer to the tax threshold, even small amounts of interest can tip them into paying tax. Over 10 or 15 years, that difference adds up. So ask yourself, are your savings working efficiently, or are they slowly leaking tax? Another pressure point is the state pension age. For many people born after 1960, the state pension age is rising to 67. That means 1 extra year before receiving full state pension payments. 1 extra year you must fund yourself. That could mean using savings earlier, working longer, or reducing spending. And here is something many people forget. If you stop working before your state pension starts, that gap must be covered somehow. Have you planned for that bridge year? Now let's move from problems to practical solutions. Here are 3 smart strategies many experts are discussing. Strategy 1. Check your national insurance record. To receive the full state pension, most people need 35 qualifying years of national insurance contributions. But many have gaps. Career breaks. Time abroad. Low earnings years. You can check your record online through the government portal. In some cases, you can pay voluntary contributions to fill missing years. That can increase your state pension for life. Think about that. A one-time payment could increase guaranteed income every year in retirement. Strategy 2. Plan pension withdrawals carefully. Instead of taking large lump sums randomly, consider spreading withdrawals. Smaller, controlled withdrawals can reduce the risk of emergency tax deductions. And always check your tax code before making large withdrawals. It sounds simple, but small timing decisions can save hundreds or even thousands over time. Strategy 3. Balance flexibility and security. Many retirees use drawdown, which means keeping their pension invested and taking money gradually. Others choose an annuity, which provides guaranteed income for life. Drawdown offers flexibility. Annuities offer certainty. Some financial planners suggest combining both at different stages of retirement. Flexibility in early retirement. More security later. Because the biggest risk is not just market drops. It is running out of steady income. While we focus on the UK system, similar trends are happening globally. Aging populations. Government budgets under pressure. Tax thresholds not keeping up with inflation. The UK is not alone. So wherever you are watching from, this issue matters. Let me leave you with this. Retirement is no longer something you set and forget. It requires awareness. It requires checking your tax code, your allowances, your savings structure, your national insurance record. Because small silent rules can have long-term impact. So here is my question to you. Have you reviewed your retirement income this year? Or are you assuming the system is working in your favor? If you found this breakdown helpful, share it with someone who is approaching retirement. Subscribe for clear explanations on UK and global financial changes. And let us know in the comments what topic you want us to cover next. This is your money, your future. And the earlier you understand the system, the stronger your position will be. Thank you for watching.